I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs that are not unanchoring inflation expectations, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
So I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
I find it appropriate to hold our policy rate at the current level for some time.
Fed speak is in focus as officials give conflicting rate cut outlooks for this year. Chris Waller and Mary Daly calling for cuts, while Adriana Kugler thinks the central bank should stay on hold for now. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Chips also sharing the spotlight today, with TSMC shares jumping in Taipei as a surprisingly bullish outlook shores up bets on the strength of the AI boom. We hear exclusively from CFO Wendell Huang. We'll discuss that and the other forces driving the market moves with St. James Place Asia and Middle East CIO Angelina Ang. Also ahead, the crypto sector getting a major win as Congress passes a bill regulating stablecoins, paving the way for their broader use in finance. We assess the impact for Asia's would-be crypto hubs with blockchain intelligence firm TRM Labs and the head of Coinbase Singapore. Plus, Indian hotel still sees double-digit revenue growth this year, despite a first quarter profit miss. We'll get the outlook exclusively from MD and CEO Puneet Chhatwal. Well, Asian stocks are extending the global rally today. Solid data and earnings optimism helping to calm the uncertainty caused by Trump's tariff war. Meanwhile, Chris Waller's call for a Fed rate cut this month, leaving the dollar under pressure. Avril Hong is here. Avril, how are markets taking the Fed speak?
Yeah, Has. I mean, most of the Fed speak reaction is being reflected in the dollar, which up until recently had been stabilizing. The idea that most of the trade fiscal policy risks had already been priced in. But as we saw just a day ago, facing fresh pressure given the chatter surrounding Powell, and then now these comments from Waller that the Fed shouldn't wait until the labor market deteriorates to cut, and that it should do so in 2 weeks when it next meets. Of course, as you know, Waller is among the names touted to succeed Powell, and overall the consensus view on the dollar seems to be that it will be the asset most at risk if Powell is replaced. Now let's flip the board and take a look at stocks, because it's really a different story there. When you look at Asia's benchmark, it's at the highest in 4 years today, getting a lift from TSMC following its bullish outlook. If you're looking at US stocks following on from those all-time highs, we're seeing the futures potentially pointing to yet another advance. Now, investors really focusing on the solid data. Think about retail sales and how that helped to ease those concerns about U.S. consumer spending. More recently, we've also been seeing these earnings revisions. The momentum there has been rising as well. Even Mike Wilson of Morgan Stanley sounding bullish. Take a listen.
I mean, I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. They've been surprised we haven't gotten one. But this is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe. But I really can't see more than a 5 or 10% correction given what I see now in the landscape.
Mike Wilson, as you know, not so long ago was among Wall Street's most steadfast bears, and even he is sounding increasingly bullish. The idea here that both corporate America and the U.S. economy can withstand tariffs, Haas.
And data is kind of supporting that. Avril Hong, thank you. Our next guest says while the U.S. makes a significant part of her portfolios, she's been cautiously underweight the market based on valuations. Angelina Ang is Asia and Middle East CIO at St. James Place, which manages $250 billion in assets. Angelina, good to have you with us. So we heard from Waller. How seriously are you taking his call for a rate cut this month?
Before I answer your question, good morning, Haslinda. Let's just talk a little bit about the Fed and its mandate and the independence for Fed. Now, Fed's mandate is to maximize employment and to stabilize prices. Let's look at the data. The June's jobs report says that unemployment is at 4.1%, which is at historic lows for U.S. And the CPI, June CPI is at 2.7%, which is actually slightly higher than the long-term 2% target that the Fed should be aiming for its stabilized price returns. Now, what Waller is pointing out is that the private market's jobs may not appear as strong as unemployment figures are showing because actually the hiring growth hasn't been as strong. Now, some are arguing that is due to Trump's attack on immigration. So really, it's a mixed view, but really what the market is really worried about is that Fed does stay independent. Fed's been given its independence because exactly they recognize that monetary policies can be unpopular. And really at the moment, there are no strong data that points to the need to be lowering interest rate. On the other hand, Trump's frustration from Powell really comes from the fact that Trump really would like for Powell to be to be lowering interest rates so that he can become that popular politician. And this really really is pointing to a reaction in the market. Fortunately, Trump always chickens out, as we have seen in the last couple of days in his attack on and pressure on Powell to step down. But what we are seeing in the market is that really this is causing a significant weakening in the US dollar. In fact, since Liberation Day, you can see data showing that while US Treasuries have stayed more or less the same levels as prior to Liberation Day, the US dollar has weakened significantly. And what we see that signaling is that investors globally are indiscriminately selling their US dollar assets.
So you've been underweight U.S. assets. Why is that, especially when you consider that the data coming out of the U.S. has remained pretty much intact and it's showing resilience rather than fragility?
Yeah, absolutely. And this really comes down to our fundamental belief in investment. So I think most of the investment advisors will be saying that choose a robust process and follow that process with discipline. Our process is on valuation. So we look at valuations against historic levels, against fair values, against basically a lot of factors that come into our proprietary models. And with that, we then layer that on with considerations of the fundamentals of the assets that we're currently looking at. We look at the current economic environment, whether that is headwind, tailwind, and we also look at are there actually any tail risks that we need to be aware of in building that portfolio. And then fundamentally, really what we look for in a portfolio is what is the most rewarding risk we want to be taking any point in time. So when you come to investment, it's all about taking risk, right? But actually sometimes you could be taking uncompensated risks, such as currency quite often is seen as one of those. Even investing cash, just on that point, has with it risks in the fact that you are not compensating for future inflation. So really, when we're looking at portfolios, we really are looking at what is the most rewarding risk. Coming back to our positions on US and applying that process and philosophy, let's look at valuations first. US has done phenomenally well over the last decade, particularly even stronger over the last 2 to 3 years post-COVID. However, what that means is that it has been coming to the upper extremes of the valuation against what we would believe to be the fair value of the US market. added to that the tail risks, right, of the asset classes. So in particular, the concentration risk. I think for the last year or 2 years, many has been talking about the Magnificent Seven or Magnificent Seven. Many had been talking around Liberation Day, and really that shows that the perils of being investing in such concentrated market. Adding that to the economic environment, we talked about tariff quite a lot, the very unpredictable policies, trade policies that Trump seems to be sort of changing on a daily basis. And really that adds a lot of headwinds to the US as a market as a whole. And fundamentally, I think the investors are right to be worried about really investing in the US market.
So you're taking issue with valuations, with the potential impact from tariffs. So how should you be invested? If you're pulling money out of the U.S. market, where are you investing in?
So as I mentioned, we really look for where we believe is the most rewarding risk. And at the moment, we really see a lot of opportunities in Europe where there's actually more diversified and more defensive assets. There's also been quite interesting economic tailwind, particularly around Germany's big defense spending bill. And similarly in Japan, we have been seeing quite a lot of interesting opportunities and economic support for a lot of the companies. There's very strong balance sheets that we are observing. Actually much more in the small and mid-cap spaces, and also Japanese yen in itself has also always been a diversifying asset. Now, the one point I do want to make it clear, though, is that when we talk about underweight versus overweight, we're not really talking about complete convictions, i.e. completely divest from the US or completely let's all invest all of that money into Europe or Japan, which are the two that I mentioned. What we're really saying is actually let's look at the portfolios. Let's still have a very diversified portfolios, but really have a position with regard to a benchmark. So as an example, on the US underweight, the MSCI ACWI, take that as a benchmark, that's currently around 65% in the US market. We are invested around 45 to 50% of our equity portfolios into the US. Now, that is a significant underweight to the benchmark, but actually it still represents a very significant part of our overall investment.
Angelina, let's take a look at Japan. You did touch on Japan and the yen. We have core inflation in the country above 3%, putting a lot of pressure on the BOJ. How are you looking at the next moves possibly from the BOJ, and how are you looking at the Japanese market in relation to that?
Really what we're looking at is probably more holistically over a longer period of time around the Japanese economic environment. Now, to say in the short term, we are watching very closely the increasing in the debt to GDP ratio. In fact, Japan recently has reported its debt to GDP ratio at 22%, which is actually the highest of all of the developed markets. So we're absolutely keeping an eye on that one. Having said that, as I mentioned, when we're looking at micro markets environment, we are seeing quite supportive signals, particularly actually most of the companies we're seeing extremely strong balance sheet. We're seeing the normalizing environment since the beginning of the last year, when the Japanese interest rate has finally turned positive after 8 years of being in the negative territories. And all of the companies are actually looking at how to efficiently spend all of the cash really on its balance sheet. And as I mentioned earlier, we saw that quite a bit over probably the last 3 to 4 years with a lot of the large caps in Japan. We're now seeing a lot of that coming through to the mid and small cap.
How are you assessing the risks of the election over the weekend? How are you factoring that in?
So that's not something that actually we necessarily have really sort of been specifically or very focused about. I think to our point, we tend to find that short-term political pressures, such as Trump, such as actually last year when we saw lots of populist politicians come into play, and therefore populist policies come into play, really impacting the shorter-term views of the market. But what we are really looking for is that underlying fundamental economic sort of views of actually how is the market, what is supporting the market.
Angelina, thank you so much for that. Angelina Lai of St. James Place. Now, still to come, we'll hear exclusively from TSMC CFO Wendell Huang as the chipmaker surprises with a bullish outlook underscoring AI chip demand while also navigating ongoing US-China tech tensions. Keep it here with us. This is Bloomberg. Welcome back to Insight. Here are some of the stories we're following. President Xi Jinping has questioned whether all Chinese provinces need to pursue AI and EV industries, warning of overcapacity and price wars. His comments in a meeting this week appeared on Thursday on the front page of the People's Daily. It follows growing concerns about what Beijing sees as irrational competition and deflationary pressures tied to those industries. Wells Fargo is said to have suspended employee travel to China after an Atlanta-based trade finance MD was recently barred from leaving the country. The employee was born in Shanghai. A source says that's led the bank to restrict travel for other staff. In a statement, Wells Fargo says it's working through appropriate channels to bring her back to the U.S. The U.S. Commerce Department is imposing preliminary anti-dumping duties of 93.5% on Chinese imports of graphite. This comes after a U.S. Trade Association filed petition to investigate whether Chinese graphite producers were unfairly subsidizing prices. The new effective tariff will hit 160%, raising stress on global EV supply chains already facing Beijing's export controls on rare earth materials. And President Trump has asked the Supreme Court to turn away a challenge to his tariffs that he says should work through lower levels first. The case involves two educational toy makers arguing Trump overstepped his authority, issuing tariffs under an emergency act. While that filing asks for the Supreme Court to rule before a federal appeals court does, the U.S. Solicitor General says they shouldn't leapfrog lower proceedings. Fed Chair Jerome Powell has denied claims that renovations to the central bank headquarters in Washington include VIP elevators. He's written a letter in response to correspondence from the White House Office of Management and Budget. The criticisms of the $2.5 billion project have coincided with a continued push from Trump and his administration officials for the Fed to lower interest rates. And shares of TSMC rallying after the chipmaker boosted its revenue growth outlook for this year in a big show of confidence in global AI spending. Let's bring in our tech correspondent, Annabelle Drulis in Taipei, who's just spoken exclusively with TSMC CFO Wendell Huang. Val, what did we learn from that conversation?
Yeah, that's right, Has. We've just wrapped a very wide-ranging 45-minute conversation with the TSMC CFO, Wendell Huang. Now, we had those earnings out yesterday. I mean, we've got TSMC already higher in the session so far, actually looking at a fresh record high for the stock price as well. And this is off the back, of course, of those earnings that we had yesterday. Very strong numbers across the board, beats on a range of different metrics. But there was a couple of themes that really came across in the earnings as well, and that was really around this uncertainty on the macro environment. And of course, I asked Wendell Huang about this. What do you mean exactly by the macro environment? He certainly means that risk of tariff policies and what President Trump is going to do. But here's what he said to me. Take a listen. Congratulations on another strong set of results. What were the key takeaways for you from the earnings?
Well, we'll continue to see the strong demand for AI. And that's the reason that we revise up our whole year outlook to around 30%. The continued strong AI demand leads to continued strong demand for our leading edge technologies, underpinned by the growth of the whole HPC platform. So that's one very important factor.
You do have that raise on the full-year growth forecast. What you didn't raise, though, and I think what was really picked up by a lot of people, was the CapEx, because you've kept that at $38 to $42 billion for 2025. Why not lift that as well?
You know, CAPEX invested in any given year is for the future business opportunities. So as long as there are future business opportunities, we will not hesitate to invest. Now, having said that, we are mindful about the macro uncertainties these days, primarily related to the tariff policies. So we are being prudent in planning our CAPEX. Well, actually in business plan, including the CAPEX and capacity planning.
We can get to the tariff risk in a few moments, but I do want to talk about what we've sort of seen over the past few quarters, because in the last 2 quarters, if you average that year on year, you're looking at around a 95% increase. Is that sort of spending sustainable, do you think?
I think, again, it's a company of our size. It will be unlikely for the CAPEX dollar to suddenly drop significantly in any given year. And also, going back to my previous comments, as long as there are business opportunities in the future, we will not hesitate to invest.
And you did outline those business opportunities, and you did as well mention about speeding up the production in the US in particular. So how much more spending do you need to bring forward then, especially when you're looking maybe to take advantage of the tax credits?
There are a couple of questions here. Number one, how much we need to spend in pulling in? Well, we're pulling in the phase 2 by several quarters. So I wouldn't say we need to spend too much capital expenditures for doing it. The other question that you have was about the investment tax credit. Investment tax credit does help us. In the next 5 years, it's definitely generally positive, but in the next 5 years, the benefit is not that much. Think about this: the investment tax credit is to offset the asset value, the fixed assets that we purchase. And the benefit will come from depreciation in the future years. And depreciation gets amortized over the years.
But you are forecasting gross margin dilution that will expand in subsequent years.
Yes.
So how much then does the tax credit and the lift in the tax credit as well help you?
It does help in the next 5 years. But as I said, in the immediate next 5 years is not that significant, because the amortization of the depreciation expense. So there are dilution from the overseas fabs. And there are 6 factors affecting our profitability. Foreign exchange rate, of course, no control, but we will lean on the other factors to make sure our 53% and higher gross margin target is achievable.
Yeah, we can get maybe into the 53% in a little while, but just coming back on the CapEx, so $38 to $42 billion, do you see that maybe exceeding that next year then?
As I said, it's a bit early to talk about next year, but a company of our size, it's unlikely that you see a big drop all of a sudden in any given year.
You talked about the macro uncertainties, and I think what was also interesting in the numbers is that you've lifted that full-year growth forecast to a 30%, but you've well exceeded that for the first half. You've guided for a strong third quarter. What happens in the fourth quarter?
That's the thing that we were talking about, CC was talking about. We are mindful about the macro uncertainties, and therefore we try to be a little bit conservative.
I mean, a little or a lot conservative, maybe is the question.
But also, CC also said yesterday that if there's really business opportunities, we'll be able to capture that.
Our Bloomberg Intelligence team.
Great conversation there, Belle. Annabelle Drillers with TSMC CFO Wendell Huang there. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The crypto industry has secured a watershed victory after the U.S. Congress passed key legislation regulating stablecoins. The regulatory clarity paves the way for more mainstream adoption of the technology in finance beyond just the crypto sphere. The successful vote comes after days of infighting within the Republican Party that almost derailed President Trump's promised Crypto Week. Let's take a look at where Bitcoin is trading right now. Look at it go, surpassing 120 right now, and that's $120,000, currently up by 0.6%. Ether, not to be outdone, currently up by about 5. Now, Circle, which issues a top dollar-backed stablecoin, has jumped 25% this week, and Coinbase, which has a revenue-sharing agreement with Circle, hit a record high. And crypto sentiment also getting a lift, with Trump reportedly set to open up the U.S. retirement investment market to digital assets, gold, and private equity investments. The FT reports Trump may sign an executive order as soon as this week. Well, for more on the growing optimism in crypto markets, we're joined by Hassan Ahmed, Country Director and CEO of Singapore at Coinbase, the biggest crypto exchange in the U.S. Also with us, Angela Ang, Head of Policy at TRM Labs, a blockchain fintech firm. Good to have you with us. Angela, let's start with you. Is it really a game changer? It is a long time coming, and some say, you know what, it's already been priced in.
It is a long time coming, indeed. I think, but I think it is a game changer. Crypto Week and the huge bipartisan support that we saw for the legislation, I think is a great signal that the U.S. is finally ready to compete as a global crypto hub. For years, the U.S. has been lagging in regulatory clarity, even as jurisdictions really in this part of the world has been moving forward, even with implementation really going into the details in Singapore and in Hong Kong. And now the U.S. is kind of starting on that journey. But why is this a game changer? It's really because the U.S. is just a juggernaut in the crypto space. On TRM's country crypto adoption index, it ranked 4th in the world. And I mean, it's just like the birthplace of so much crypto innovation. So anything that happens in U.S. crypto policy, all eyes are on it. I think regulators around Asia, around the world are watching and revisiting their own strategies as well.
So Hassan, we know Coinbase is a great beneficiary of this, and of course your share price is a reflection of that. I'm just wondering, how might this play out?
We see this as a win for really many, many parties, for the 52 million crypto holders in the U.S., for legislators that have been lobbying for the interests of their constituents, and for the industry that's been asking for clear rules of the road for a long time. So this is definitely a week where people will say, hey, where were you when this all happened? We think that this is not just a milestone, but this really is a turning point of having something very clear, very direct, having workable rules that provide consumer protection, that allow for innovation to flourish. And we think this is going to unlock a lot of capital for the industry as a whole.
But the thing is, there are naysayers out there, Angela. Some say, yeah, you know what, we have these bills, but there are very few regulations. You're not really that protected, and it does not even put a lid on Trump's ability, for instance, to benefit from his family's crypto exposure.
Hey, look, I think if there's one thing I've learned after being in crypto policy for this number of years, is that it's a completely iterative process, right? And we're really just at the beginning. So, I think we are going to see that, like Singapore has gone on that journey, Hong Kong has gone on that journey. We've seen regulatory frameworks evolve, even as market conditions evolve, even as market sentiment, political sentiment evolves. And I think the U.S. is right now just at the beginning of that journey. So I think it's a huge step. The bipartisan support is important. The fact that there is legislation is a huge win in terms of regulatory clarity. But there is still a lot of work to be done, and we haven't even gotten to the implementation phase yet.
Okay, so Hassan, finally, the U.S. is playing catch up in terms of regulation. What does it mean for crypto hubs in this part of the world?
Yeah, this is going to be a big unlock overall and globally. However, I don't think that the benefits are going to be evenly divided. I think that the big thing for everyone else is that this is a wake-up call. The U.S. has not just said, hey, we want a basic regulatory framework. They're saying that we want to be the world leader in digital assets and AI combined, and they have a policy that is going to oversee and national intent behind it. So as Angela was saying, there's many other hubs that started taking this journey a long time ago, and they have regulatory clarity, including in Singapore, Japan, Hong Kong, and others. However, this is also the time to provide more full-throated support for this technology and this industry. Otherwise, what's going to happen is that entrepreneurs, companies, capital allocators, they will look for places where now everyone has the same baseline, but who's going to provide me that additional cover to make more long-term investments and operating structures?
I want to touch on Genius Act. It is quite interesting. They say that now pretty much, even though we're going to have oversight of stablecoins, the likes of Amazon will be able to come up with their own stablecoin, and who's to say how they will be regulated? They're going to be acting like a bank itself. Are there concerns to be had here?
I think, at this point, we kind of have a common understanding in the regulatory community about what a stablecoin means. In terms of like fully backed by reserved assets, timely redemption at par. I think regulators are looking at this because they recognize that stablecoins marry the benefit of having being a stable medium of exchange with the benefits of transacting on the blockchain, its speed, cross-border transparency, and so on. So I think the stablecoins are being held to a different standard today. And that is going to continue to evolve. I think it is going to continue to evolve commensurate with their impact on the global financial ecosystem.
Your thoughts?
Yeah, this is the big implication here is that stablecoins are now going to be enshrined in law, and no future executive actions will be able to overturn what gets passed, hopefully at the president's desk this morning. And what that does is it allows for this technology to really start profligating in a way that just wasn't possible before. And where we see this is going to sort of really unleash more innovation is around the global payment system. First and foremost, we are going to see more first-party issuers most likely. When we talk to other executives, 3 times the number of Fortune 500 executives are now looking at stablecoins than was the case last year. So I think what's going to really happen is there's going to be big banks, scaled-up consumer techs, as well as crypto-native platforms that are going to really come together and stitch this, from something that was more on the sidelines into the very fabric of global finance itself.
Both of you talked about how this is a wake-up call because the U.S. is going to be a serious player and is showing so in terms of its regulation. How will it change the face of regulation in Asia? Will it have to play catch-up now, accelerate the pace of regulation to stay ahead?
I think the fortunate thing is that Asia is very much more advanced in the field of crypto regulation, but I think it is the fabric of regulation, right? It's the tone of regulation. And I think here, Asia Pacific as a region, governments here have always been very sensitive to competitive dynamics, and everyone for the entire year has been watching to it, alluding to, now that other countries are revisiting their stance on crypto, we might as well. So I think, it's not more regulation, but it's what kind of regulation. And I think it's really about having clear and proportionate regulation that understands the infrastructure that you're dealing with and enables growth as well.
Are there regulatory gaps that need to be filled?
Well, most of the basic regulations to do around AML, guardrails, and consumer protections are in place already. In fact, jurisdictions like Singapore have done a fantastic job at consumer protection uplifts. So we think that the necessary baseline is complete. There are now fit-for-purpose legislations around stablecoins that are coming into being. However, I think what's more important, along with the protections, is now how do you accelerate innovation? How do you encourage capital formation? How do you make sure that there is retail access for these new kinds of primitives that are coming up within crypto? And I think being more balancing the tone with being more business and access friendly is, I think, what's needed for Asia to catch up.
Okay, so in terms of regulatory framework and environment, we're moving in the right direction. Talk to us about the momentum you're seeing in the crypto space. I mean, we're looking at Bitcoin in excess of $120,000. Surely there is momentum. I mean, that is proof in itself. How much more can we expect given the regulatory environment?
So look, this is an incredible week, right? And the momentum has been building up ever since, frankly, the U.S. elections. And what it's really saying is that markets hate uncertainty. And so now that we're reducing this uncertainty, we're putting
But a lot of it has been
clarity.
priced in already in the prices, right?
I think the markets are observing. They're putting in probabilities of where this is going, and I think that what's happening alongside of that is secondary effects like these crypto exposed treasury companies. That was a phenomenon we did not see coming a year ago, and so there's new sources of demand that keep getting unlocked as further clarity comes in. So this announcement about 401ks, there's $8.9 trillion in 401ks in the U.S. So once they get exposure to alternative asset classes, that again, may provide another source of demand. So I think it's too early to say that hey, all of this is priced in. I think we're seeing it playing out in real time. But one thing is clear: the momentum and the excitement around this dynamic asset class is really coming into its own in a big way.
Angela?
Yeah, I think we're just at the beginning, especially when we talk about the wave of institutional adoption. I think when we talk about regulated large financial institutions getting into the space, regulatory clarity is a huge driver of getting that comfort. So I do think the sentiment in the industry is hopeful. It's collaborative. I think we don't want to talk about like TradFi and DeFi as like two separate ecosystems, but it's really one part of a whole. And seeing that momentum with players from both sides entering into the digital asset space, I think we're still just at the beginning of that, and yeah, very hopeful and for the future ahead of us.
I have to ask this question. So where do you see Bitcoin at the end of the year?
Well,
give a number.
I don't know, Hassan.
We're very excited about the long-term prospect, right?
What is that? Quantify that for us.
So look,
in terms of Bitcoin price,
there's different views. All of them we think is one more bullish than the next. So you're seeing everything from people saying, hey, this is easily going to double by the end of the year to beyond. Again, you can assign your own probability to it, but what we're seeing is that there are just new sources of long-term capital that is wanting to get access to this asset class, whether it's for a store of value or a macro hedge or whatever the investment thesis may be.
Yeah.
So we're still I would say not in the early innings anymore, but we're kind of in the middle innings of how this cycle is playing out, and it's all looking very, very encouraging so far.
So given all the positive signals out there, I'm just wondering in terms of your both companies, how are you positioning? What are you looking at? Or what investments might you be looking at on the back of the optimism? Angela?
Yeah, I think for us, we basically are in the space of crypto compliance, and so when you talk about regulatory clarity, that's great because we have been working with regulators around the world, in the US, in Asia, to kind of shape how can we leverage the unique properties of blockchain being transparent and being traceable to really engender better financial crime risk management outcomes. And I think there is a greater understanding of that, and along with regulatory clarity, along with regulatory and compliance maturity as the industry kind of embraces and maybe takes a more collaborative approach to regulators. I think we're seeing very positive momentum. We really have to continue this dialogue. We are very much kind of playing a bridge. We see ourselves playing a bridge between our customers in the public and private sector to really have a positive dialogue on the direction of travel when you talk about crypto policy and compliance.
What does it mean for Coinbase? Are you hiring more? Are you making more acquisitions?
This is the most excited and energized I've been since I started the office here for Singapore and Coinbase. We are doubling down our investments into our product suite. For core consumers, we have our core trading products, but we also announced our payments product and also Coinbase for Business as well. We're going to be bringing all of those products over to our Asia franchise as well. And in addition to that, we also launched Base, which is our layer 2 blockchain, and we announced some huge enhancements to that actually just yesterday. So for us, it's more about how can we expand our suite of products and just service our users better than we ever have.
I am quite sure Hassan's throwing a party over the weekend. Angela Ang of TRM Labs and Hassan Ahmed of Coinbase, thank you so much for your insights today. Now, still to come, Indian Hotel CEO Puneet Chhatwal will be joining us for an exclusive conversation on his outlook for the hospitality sector following mixed first quarter results. Keep it here with us. This is Bloomberg.
if other nations are subjected to a much higher tariff than Indonesia, perhaps that will put Indonesia at an advantage to this arrangement. At 19%, if I'm not wrong, is probably the lowest among surplus countries with the United States. So clearly, this is very much welcome.
19 is still better than 32, and 19 relative to other countries at the moment anyway is still lower than our other competitors.
We did see China's export to the U.S. starting to show slowing down, especially when tariff took effect in April. But overall exports has been stronger than expected.
APEC is this year being hosted in Korea. Pretty hard to see much progress. But next year it's hosted in China, and I imagine the Chinese are going to really push to move things probably along the free trade area for Asia and the Pacific.
Some of our guests this week sharing their insights on the latest trade developments. Now, tariff issues are also on the radar for the hospitality industry, but Indian Hotels says despite geopolitical headwinds, they're still expecting the sector to show resilience and sustained growth. The company's reported net income for the first quarter that missed analyst estimates, but they're maintaining expectations for double-digit revenue growth for the full year. Taking a look where Indian Hotels are trading right now, currently up by about 1% as we speak. Joining us exclusively, Puneet Chhatwal, MD and CEO at Indian Hotels Company. Puneet, good to have you with us. Well, your stocks are higher despite kind of disappointing results. I'm just wondering how you're hoping to do better in the second half of the year.
Good morning. I don't know what is so disappointing about the results. We have done much better than last year. Our profit after tax is up almost 20%, 19% to be precise. I think what will happen in the next coming quarters, hopefully without the geopolitical tensions, is that the second half, we have very strong openings pipeline, and we'll be opening at least 20 hotels in the second half of the year. And of course, we have openings in the second quarter also. So our total openings, and that too on the capital light model, will take us much beyond 270 hotels, 275 in operation, up from 249 today. And all those are also expected to contribute despite all the challenges that we had in the openings in the first quarter. So the growth is one part, and the robust occupancies and good rates is the second part. The combination of that should keep giving us tailwinds in moving in the right direction.
You talked about robust occupancies. What kind of occupancy rate are you anticipating? And the other thing is about the opening of hotels. You're currently about, 390? When will you get to 700?
700 is the target we have given for year 2030 as a total portfolio. And you're absolutely right. Today we stand at 392 to be precise. And we are expecting another strong year of signings and openings I already alluded to. What I personally see is that the imbalance in demand and supply will keep benefiting the sector. So the occupancy levels will stay somewhere between 74 to 76%, which is 10 basis points higher than what it used to be like 10 years ago. And that gives you the ability to charge and the ability to have a healthy level of pricing. And that is what has benefited the sector in general and also our portfolio in particular.
For Indian Hotels Company, it's not just about the Taj. It's also about Ginger. It is about Vivanta. What are the plans for those brands? What's the strategy?
Well, thank you, Haslinda, because Ginger is really a brand to watch. It's a very important mid-scale proposition for a heterogeneous country like India. We've achieved a portfolio of 100 hotels, but we have very ambitious plan to scale it up as fast as we can. And hopefully by the end of second quarter, I'll be able to share more on those plans, because as we speak, we are on the drawing board, drawing out various strategic options to grow as rapidly as we can with a brand like Ginger. We want to maintain Taj in its absolute premium luxury position. Recently, it was again awarded as world's strongest hotel brand and India's strongest brand across all sectors. So we want to maintain that position, selectively grow with Taj outside of India. In the third quarter or latest in the fourth, the opening of the Taj in Frankfurt, Germany is imminent. And also we are opening 2 properties in Bhutan, in Paro and Phokchika, in the second half of this year. So we are very excited about that. And we're also opening company-owned assets, the 2 of Vivanta, as you mentioned, and also a Ginger in a place called Ekta Nagar, which is symbolic for the Statue of Unity, the highest statue in the world.
Puneet, talk to us about your capex plans for the next 5 years. We know that your chairman talked about investing $1 billion. Take us through what that entails, how that will happen.
Well, there is a normal capex, which is approximately 3 to 5% of your total revenue. That's your routine capex, which we keep investing in our assets, especially the ones that we own, and also on the management fee business, but that's the cost that goes to the owner. Obviously, our chairman also alluded to some company-owned projects. As we are in this very important growth phase, we are debt-free and we have cash reserves, and we've been using our internal accruals to also grow company-owned portfolio for any project that is very much making sense. And on top of that, very recently also got help from the Tata Group, which have bought an asset for us in the city of Kolkata next to the airport, which will be finished and opened in the next 2 to 14 months.
The thing is, Puneet, you have big plans, yet when you take a look at your shares, they're not doing too well. They're down 16% year to date. How do you intend to provide value to your investors? Are there plans to turn around, the lackluster performance of your stocks?
I think the stock ran up very fast in the last 5 years. If you look at a 5-year return, it goes to more than 800%. So yes, the year to date, we have had a challenge in the market, but also it has something to do with the geopolitical situation that we have gone through. Also, the Indian stock markets in general have been a bit more sluggish than they were in the last few years. Our job as management is to walk the talk, to deliver on the promises that we made. The rest is obviously in the hands of the markets, whether they reward us or they punish us.
Puneet, a pleasure to speak with you. Puneet Chhatwal, Managing Director and CEO at Indian Hotels Company Limited. Now, before we go, a preview of what we have for you next week. We're in the thick of earnings season in India. On Monday, an exclusive with Wipro CFO, Aparna Iyer. Also, GSW Steel CEO will be joining us, plus the latest market analysis with Allspring Global Investments and JP Morgan Asset Management. That is it for Insight. Keep it here with us. This is Bloomberg.